I'm Ben Keyes from the Wharton School at the University of Pennsylvania. I'm going to do very brief introductions for our panelists. Most of them need no introduction to this room. As we're thinking about the effect of interest rates on the mortgage market, housing markets, affordability, and sort of issues more broadly, there was kind of no other team of people that I thought we could put together who could better discuss the topic. I will just do a quick round of introductions and then we will jump in. So to my left is Ingrid Gould Ellen, who is the Paulette Goddard Professor of Urban Policy and Planning and the Director of the Furman Center for Real Estate and Urban Policy at NYU. To her left is Mike Fratantoni, who is the Chief Economist and Senior Vice President of Research and Industry Technology for the Mortgage Bankers Association. To his left is Sam Khater, who is Vice President and Chief Economist of Freddie Mac. And to his left is Lu Liu, who is an Assistant Professor of Finance at the Wharton School. And so as we're thinking about this issue of rising interest rates and its sort of the broad set of effects that it's having on the mortgage market, Lu, I thought I would start with you, given the research that you've been undertaking, to give us a sense of sort of where we are in this interest rate cycle and what are some of the first set of effects that we're seeing.
Thank you very much. So I'm very happy to kick this off and talk a little bit about where we are in the interest rate cycle. So we've experienced about 3 decades of broadly declining interest rates, as well as mortgage interest rates. So that's what this plot is showing here. And then since the beginning of 2022, we saw a sharp rise in rates, kind of 2022 to 2023 tightening cycle, such that some households, I imagine some of you in the room, who are basically lucky enough to refinance at the trough around the pandemic era, where a lot of US mortgage borrowers took out mortgages at levels of 3 or 4%. Whereas if they had to remortgage at current market rates, they'd face rates much closer to 7 or 8%. And so in very recent research, we basically show, right, that this is very valuable to households. And we estimate that the low rate that people have on average locked in is about 4%. And thinking about the kind of future expected payments that people save compared to current market rates gives us a number of about $50,000 US for the average mortgage borrower. So that's the kind of orders of magnitude that we're talking about. And so the image that I want to give you, you may have seen in the press, is one of golden handcuffs. So the fact that you've got a low rate locked in, right, is great for you. It's kind of golden, right? But the issue is that it may also lock you into your current house. So the concern is that people are, because they want to hold on to their low mortgage rate, people are not moving for better paid job opportunities elsewhere, or they're not moving to, for instance, houses that are better suited for their families. And so to give you a brief kind of, a little glimpse into the paper and the mechanism, I really want to emphasize that this is an asymmetric effect when interest rates tighten. So the effect on moving is not present. So let's start out with when interest rates are declining, such that the rate that you've got locked in is much higher than the rate that currently is prevailing in markets, right? Ideally, maybe it's good for you then to remortgage and get the low rate, right? You're going to save mortgage payments by doing so. And that is actually not going to distort your moving decision in any kind of way, because in the current US system, the mortgage contract has a refinancing option typically for you. And so you don't have to move in order to obtain a low rate. And so what we see, this is a simulation, but in the data, we basically see that there's no relationship between moving and the rate. So basically the rate difference, and when the rate is much higher than the current rate, that's a positive number. And so we don't see an effect on moving. However, wrong direction. However, when we go in the opposite direction, where the locked-in rate is lower than the current market rate, meaning where the difference that I'm plotting on the x-axis is getting more negative, basically the fact that you can't, when you want to move, you basically have to give up your low interest rate. And that corresponds basically to a financial cost that you're paying that distorts your moving behavior. Basically, it's a financial friction that is a financial cost of the order of magnitude that I just spoke to you about. And so we see that in the data, and what we estimate for the most recent, for the 2022 to 2023 tightening cycle, a 1 percentage point deterioration in this. So if you're more locked in by 1 percentage point, that's going to reduce your mobility by about 16%. So if you scale that, right, by the numbers that we've seen, the tightening cycle, you go from about, on average, 4% mortgage rates to 7%, say that's a 300 basis point increase. That would suggest that the most recent interest rate tightening cycle will have caused people to move less by about 40 to 50%. That's a staggering number. So we updated our estimate. They are much larger for this tightening cycle. But I want to show you some evidence that this has already shown up in the kind of order of magnitude that we're thinking about, and in particular, not just on the mortgage market, but also on the housing market. So this is a chart from the National Association of Realtors that shows the numbers of homes sold, so existing home sales, which is a vast majority of US housing transactions. And you see they hit about 6 million, I don't know if the pointer works, yeah, about above 6 million in January 2022. And as rates rose in the orange line, you see that there's been a corresponding decline in the number of houses transacted, such that in 2024, January 2024, there's been more than a 2 million drop, which, if you think about the percentage change, is about a 40% drop in housing transactions. And it's now at levels last seen during COVID, and prior to that, last seen only after the Great Recession. So basically, mortgage locking, the fact that people have a low rate locked in and that they want to hold on to it, has led people to not move, to stay in their houses, which has obviously had repercussions on other actors, other households, housing market liquidity, and has raised calls for policy solutions and other interventions. And with that, I'm going to hand it back to Ben. Hopefully we'll be able to discuss those as part of it.
Lou, that's great for kind of setting the table and giving people a sense of some of the facts of where things are at the moment. Sam, if we're thinking about the adjustments that a potential home buyer could make, you could stay on the sidelines and continue to rent. You can adjust in terms of the contract that you might take, the amount that you borrow, the type of house or the location of the house from your perch. At Freddie Mac, what are you seeing in terms of home buyer responses?
Yeah, good afternoon, everyone. I'm delighted to be with you today. Thank you. I'd like to thank Ben and Neil for the invite. So we're doing some work in real time that looks at how borrowers are adjusting to the market. So we've created a price to rent metric. It's a little bit similar to Paul's that you did a few years ago. And what we do is we do it for the same home. So we do this for single family homes. We get the rent for the single family home, and then we get the price. We use our internal AVM, but we have used the actual price for that home as well, and it works out the same. We ended up using AVM, just gives us more data. For the rent, the single family rent, we used our internal purchase applications data. The MLS data is great for single family rents. I've used it, a lot of others have used it, but the reason we use our internal purchase applications data is we've got about 4 times the rent data in the MLS for single family homes. So we create this price to rent ratio for the same house. So it's sort of, as micro level as you could be. We go back to 2000 and we look at that price to rent ratio just to get a sense of sort of affordability at a very micro level. And when you look at the difference between the monthly payment using the price and the rate versus the rent at that home, that premium was about 30% or so for between 2000 and 2004. It zooms up to 60% during the kind of the peak of right before the crisis in 2007. It collapses to about 0, rises back up to about 20% in the intervening years, and then most recently hit 45%, has come down a little bit since then. So from a price to rent approach versus price to income approach, so property income is kind of our denominator here. The market's not nearly as unaffordable as it was during the crisis, but it is more unaffordable than sort of the 2000 to 03 time period, which is kind of the last normal time period that we had that was sort of normal. So then what we did is we took that same data set and we took a look at where did these buyers, when they moved to and purchase their first home, right? These are all renters living in a single family home. We looked at the premium that they paid relative to the current single family home, right? So the price difference between the rental they're in now and the home that they're purchasing. And when we do that, it's actually really interesting. And this kind of gets to where your question, which is how have borrowers adjusted? So between 2000 and 2004, that premium was about anywhere from 6 to 8%, meaning when they moved from their single family rental home and they purchased their first home, that first home was on average 6 to 8% more expensive than the single family rental that they were in. That difference fell during the crisis, right? As the market became more unaffordable, they paid less and less. In other words, it's sort of like substitution, right? If the price of steak goes up, you'll substitute into a lower quality steak or chicken. I always feel bad with these meat eating references, but everyone knows them. Yes, thank you. And then that premium then increased to about 18% during the crash because housing became much more affordable. And then it sort of normalized down to the 6 to 8% range between 2018 and 2020, but has fallen further and is down to almost pre-crisis levels. We're basically almost at par, anywhere between 0 to 2%. So meaning as the market has become more unaffordable, potential home buyers, first-time buyers have gone down the value spectrum in order to be able to afford it. And that's one reason why, if you look at the first-time home buyer share, at least in Freddie Mac's data and Fannie Mae's data is very similar. In the 90s, the average was between 25 to 30%. And even during the early 2000s, and even at the height of the run-up in the boom, 04 to 06, the internal first-time home buyer share was in the 25 to 30% range, and it's been on a monotonic increase since then. Part of that is because there's been a millennial increase in demographic demand, but also because trade-up buyers have disappeared. This is not talked about at all. That's one of the main reasons why the first-time home buyer share has increased. But the other is that they've shifted where they've looking to buy, and I think during COVID that means smaller homes further out in the suburbs.
That's great, Sam. I think, it certainly speaks to the ways in which home buyers have to adjust in the face of substantially higher costs of ownership. Ingrid, I wanted to ask you sort of about the sort of broader consequences for affordability and kind of if you can kind of broaden our lens a bit to think not just about maybe the implications of these higher rates on homeowners or potential home buyers, but also what this might do to rental markets.
Yeah, I'm happy to do that, and thank you for asking me to be here. I'm really happy to be on this panel. And it's been, I'll focus a little bit more on rental housing, but I think that the impact of higher interest rates, the impact of the lock-in that Lou was talking about, really does have spillover effects on the rental market too. And, most obviously, if, would-be buyers can't transition into homeownership, if it's that much, some of them may be sort of going down the quality spectrum or finding homes further out. Many of them are just staying renters. And so you have sort of like a bubble of renter demand that has it. And you've seen sort of, rental demand surge during the pandemic. And I think, continues to be elevated. And then there's sort of on the supply side too, right? Is that higher interest rates mean that there's going to have some implications for construction. It's more difficult for developers to get loans. It's more, the cost of debt to build and acquire multifamily housing has increased. Meanwhile, both because of higher interest rates, but also because of some of the failures in the commercial mortgage market. The signature failure. That lenders have tightened in the multifamily market. So according to a survey, probably some of you may have been involved in, the Fed survey suggests that 2/3 of multifamily lenders sort of tightened their underwriting between 2022 or during 2023. And at the same time, higher treasury yields means it's sort of harder, it's more expensive to get equity. So, the end result has been a decline in demand for multifamily loans, with multifamily mortgage borrowing down about 48% between, the middle of 2022 and the middle of 2023. And partly as a result, multifamily construction has declined too. Starts are down about 30%. Now there's still a lot of supply coming online because there were a lot of units that were sort of already underway. So it may take some time to sort of see the decline in supply, the effects on the market. But if interest rates continue to be high, I think this is a concern, because you are seeing multifamily housing starts fall. And the third impact that sort of on the rental market, it's not so much on the supply of new building, but operating costs have also gone up considerably. And both because of higher interest rates, also because of insurance. Property insurance has gone way up. I mean, I think that operating costs have gone up about 10% for. And actually, I think that's even it's sort of independent of the debt service. And that's put pressure on landlords to increase rents, to defer maintenance, potentially to sort of cut back in the rental market. And all of this has contributed. I mean, the truth is, the rental affordability measures kind of lag because they depend on census data. So the most recent data that we have on rental affordability is from 2022. So the truth is, I can't say that much about how much of this is due to rising interest rates, but rental affordability was down. The share of renters that were paying more than 30% of their income on rent in 2022 hit 50%, and that was up 3.2 percentage points since 2019. So it's a marked increase, and actually particularly high this isn't sort of due to a compositional effect, right? If anything, the composition of renters has gone in the other direction towards higher income renters during this time period. And in fact, the burdens have increased more for some middle income renters who earn between 45 and 75%. The rent burdens went up by 5 percentage points off of a base of 35%. So it's sort of a significant increase. And so and again, not all of this is due to rising interest rates. There's a whole collection of factors, including actually declining mobility, right? You've actually seen declining mobility on the rental market too. The mobility is down, I think, something like, from 20% in 2019 to 16% in 2022. And I, the evidence suggests it sort of hasn't bumped up further. And what does that mean? If people don't move, right, it disrupts the vacancy chain. It means that there sort of isn't the inventory available. And that's restricting supply considerably, even as sort of construction starts or construction completions are still coming online. So I think there is, again, I don't have the data on the 2024 rental market, but certainly it's sort of the 2022 was kind of the rent burdens reached a level as high as we've seen since we started collecting the data.
Well, thanks, Ingrid. I mean, that's I think raises a lot of interesting questions around research, but also around policy. And we'll turn to some of those policy questions in just a bit. Mike, I wanted to turn to you and think about sort of the implications for the mortgage industry. You have this enormous wave of refinancing that happens during the first part of COVID. That refinancing wave recedes as interest rates start to rise. And now not only is there no refinancing happening, but with all these people who are locked in, kind of not moving up the property ladder, that's had a huge effect on volume. So how is the industry responding to that sea change?
Great, and thanks for the invite, Ben. Really appreciate being here. Great panel. Yeah, exactly right. If you look at application volume relative to January 2022, refi is down 80%. So no surprise when mortgage rates more than double, but purchase application volumes down 50%, very much in line with the number that Lou talked about in terms of lock-in effect. If you look at originations for the past couple of years, 2021 was the all-time high at 4.4 trillion. That fell by 50% in 2022, fell by another third in 2023 to 1.6 trillion. I would typically just focus on those dollar numbers, and I would show those numbers to my members, and they're like, that's not capturing what we're feeling. Because 1.6 trillion, you go back to like 2017 or 2018, you see numbers that are pretty comparable. So we also forecast in terms of units. 14 million mortgages in 21, again, fell by more than half, fell by more than a third. 2023 at 4.3 million units, you got to go back to the mid 1990s to see a number that low. And this then gets to sort of kitchen table kind of issues where you might be able to divide the dollars between two workers, but only one loan officer gets that loan. And so somebody's not going to have a job anymore, right? And so we've seen considerable consolidation in the industry. So total industry employment down, call it 35%. Mortgage lenders are in a cyclical industry. They're used to dealing with these cycles, right? But the way you deal with the cycle typically is you trim the back office a bit, you lay off your lowest performing loan officers, and then you sort of hunker down, save costs where you can until things turn up again. This one's different, right? You're laying off about 30% of the loan officers in the industry, right? And you're seeing massive consolidation. Now, think about some of those numbers I talked about, 80% down in refi, 50% down in purchase, 35% down in employees. Why don't those match, as difficult as 35% layoffs are? And if you look at the productivity stats that we put out, there's one that I really like to focus on, which is if you look at closed loans per production FTE. So think about everybody in a lender's staff that's working on originating loans. Average for that going back the past 15 years ago is about 1.8 loans per month, right? During the pandemic, unbelievable boom, and also lenders were unable to hire, right? Because they didn't want to bring in a green employee to this unbelievable refinance environment. So they just made everybody work 20 hours a day and paid overtime through the nose. And we get to a 3.1 productivity number, right? So that's led to lenders being extremely profitable during the pandemic. With the bust, we're down to 0.9, right? And now just even all the layoffs we've seen, we're at sort of 1.1, right? So far away from that 1.8. If you look at a cost to originate a loan, we're about 12,500. Just by comparison, in 2008, we were at 4,000. Now, why did that cost to originate a loan go up so much? Some of it's because loans are much larger now, and you're paying loan officers basis points of UPB. Some of it is this is a much more fixed cost intensive business than it used to be. Just had a meeting last week and was, this is a regional bank, met the vice president for complaints at this bank. As you might be aware, the CFPB has a whole effort getting consumer complaints. So now there's a vice president level position at a large bank. Her whole job is just dealing with sort of marching those mortgage complaints, making sure they get addressed adequately. So that's just an example that's a little bit extreme, right? But what we've seen as lenders have cut back is they keep running into these sort of places where they can't cut anymore, right? Because you need that one person in that specific aspect of quality control, and you can't have less than one person there, right? So that's how the fixed costs are really showing up as volume remains really very low. Another thing that's, I think, underappreciated, probably not in this audience, but I think in sort of media coverage of Morgan Stanley more generally, is just how different the business models are in terms of who focuses on which types of origination channels, right? So you think about the 4 different ways a lender may originate mortgages. Retail, so maybe through a branch network and a loan officer. Wholesale, where they have a broker who's not an employee, but gets the application, sends it on to a lender, may work with a whole number of lenders. Correspondent, where you have a larger institution, and both large IMBs, large independents and large banks get about half their volume through correspondent. And they're buying closed loans from a smaller originator who closes the loan in their own name. And then consumer direct, which is, think of Rocket, sort of a call center, internet based model. Those four channels have different strengths and weaknesses. Consumer direct is really extraordinarily good in a refi environment. Outside of a couple of specific names, it's pretty terrible in a purchase dominated market like we're in right now. People don't want to buy a home through a call center. They want to talk to somebody. Correspondent is generally a way to build a servicing portfolio. If you're not interested in building your servicing portfolio, you don't want one. So you might have noticed last year, Wells Fargo shut down their correspondent division after for years having had the largest correspondent channel across the whole industry. They didn't want more mortgage servicing. Broker can be wonderful because they're not your employee, so you don't bear some of that fixed cost. But sometimes the quality control you have to put around that can be more expensive than what you've given up. You've seen folks like Citizens Bank, who made a huge investment in the broker space a couple of years ago, shut it down in this kind of environment. Not worth the cost that they're dealing with. And then retail is what everybody thinks is the best way to operate in a purchase environment like this, but it's very, very expensive. A lot of fixed costs that you're dragging around with you. And I just talked to a lender last week who decided to sell off his retail division. And what he said was, I'm selling off 80% of my costs and only 20% of my volume. And he kept a broker division. So those channel decisions, I think, are really important in this environment. This is how folks are sort of living to fight another day, is deciding, okay, where am I going to sort of place my bets in terms of how the industry is going to evolve? How can I do better going forward? And then just the last thing I'll say is the one bright spot in the mortgage industry has been the servicing business. That last year, delinquency rates were at an all-time low. And if you're a servicer, you're getting paid on outstanding UPB, right? Prepayments are about as slow as they've ever been. So your servicing portfolio is persisting. Delinquency rates are about as low as they've ever been. So you don't bear those costs. Costs about $2,000 to service a non-performing loan. Costs about $170 to service a performing loan. So you want your loans to perform. Much, much more profitable business. Whether that changes, again, to this lock-in discussion, if we're in a world where prepay speeds stay really low, servicing will continue to be a very good business. So stop there.
Oh, that's great. And I have a very long list of questions to follow up with each of you. But I want to be sure to leave time for the audience, both in the room and online, to ask questions as well. So I'm going to do one more round of questions, I think, and then turn it open to the audience. You know, as thinking about where to take the conversation next, I mean, partly just thinking about some potential policy responses, and then maybe ask a couple of you to look into your crystal balls for what's going to happen to this market going forward. Lou, I mean, this is something you've been thinking about, and recently wrote a fascinating op-ed on potential policy responses. The Biden administration has floated ideas around a seller's tax credit to sort of lubricate the property ladder, which is currently stuck. What are your thoughts on some of those proposals and other kind of policy proposals to deal with lock-in?
So yeah, just to elaborate on that, I think there's a real policy conundrum. For instance, from the federal government, they basically, they know first-time buyers are suffering. They facing high house prices, high mortgage rates, and really low inventory. So it's like really, they're upset, and politicians, they know that, and so they want to offer relief. But the issue is that I think that you got to be careful with kind of fiscal stimulus and like policies that stimulate the housing market, because so I'll talk about the kind of trade-offs, but I think there's an overarching risk that they may be inflationary, right? And so you're kind of causing inflation. You're introducing policies that have an upside risk to inflation that may actually keep rates high, perpetuating lock-ins. I think that's something to be very aware of. And just to talk about the Biden policy, the proposal by the Biden administration. So that's a $10,000 tax credit to ask starter home owners to sell their house. And they've defined starter homes as below the county median price. So think about like a low priced home. So if you're an owner of a starter home and somebody offers you basically $10,000 to sell it, right? You probably need to buy from someone, right? If you're in a starter home, you may want to look at trading up, right? As we discussed at this panel. And so you're likely trying to buy from someone who's even more locked in. They probably have an even bigger house, even bigger loan, same low mortgage rate, right? And so the way you're going to get them to sell is probably by, since they don't get the tax credit, you probably have to bid up the house price so you can maybe share some of that tax credit. So you're basically splitting $10,000 along the housing ladder. And that, if you think about the numbers that I told you, right, like for the average homeowner, that's about $50,000. So 10,000 may not be enough to basically incentivize one person, let alone two or even more along the housing ladder. So there's that. There's heterogeneity amongst these types of housing. So I think if you were to design a policy like that, you would want to target it very carefully and calibrate it very carefully. So we're kind of currently to kind of highlight some research where we're trying to basically build a model of the housing ladder and evaluate these policies. I think the other way, so the reason why I think that's the kind of policy that can be proposed is that you run into legal issues if you're trying to do other things, right? So one way would be to, in a lot of other countries, you can, for instance, port your mortgage. You can take your mortgage with you, subject to, some kind of collateral verification. In the UK and Canada and a lot of other countries, you can do that. In the US, there's a due on sale clause. You have to prepay when you're moving, and then you have to take out a new loan. You can't take your loan with you. That's likely to protect mortgage-backed securities investors. So because there's securitization, these are held by an investor, a diversified pool, and so it makes it very difficult to now expose renegotiates. And Tomek has done some work after the Great Financial Crisis. And once you have securitization, you basically need to rely on services to have the right incentives to help you renegotiate, because you can't just go to your bank and ask them to maybe take some part of your loan with you and share that kind of surplus with them. So these kind of policies where you think about contractual, you're trying to implement contractual features that weren't written in when the loan was basically taken out, right? These mortgages are not portable. So you'd basically be asking, the other side. And I do think there is maybe some surplus to be had given the low transactions volumes that have been kind of affecting the industry. So there may be some bargaining ground where if you add incentives and make it legally, remove legal risks around renegotiation, maybe there is some middle ground for some of these loans at least, to take them with you, or find some kind of compromise in the middle.
Yeah, go ahead. And turn your mic on.
Sorry.
So, and maybe this is as much a question for Mike and Sam as for Lou, but I'm just curious. It's like, I understand that the sort of legal restrictions now for existing loans, but like structurally going forward, couldn't you imagine a portable mortgage product in the US that maybe you pay some upfront fee in order to have that and have that feature, which would help to prevent, lock-in in some future market? And I'm just wondering.
Yeah, I'm going to pass this on, the question of whether that's feasible to Mike. But
I would just say that
the problem right now, I think, is that there is this long stock of outstanding mortgages, right? Like people have locked in these low rates, and that's kind of the exactly, we're facing like an ex post problem. So ex ante, there's a contracting change and design that we could optimize going forward. But I think there's a little bit of a cleaning up ex post versus changing contract structure ex ante. But I'm curious about that as well.
No, exactly right. It would have to be done on a go forward basis. You got $9 trillion of agency MBS outstanding. That is just that contract is in place. You wouldn't want to mess with that, because you want to make sure investors keep coming back to that $9 trillion market as it's growing over time. And then I think it really is an open question about what an investor would charge to bear what effectively becomes a 30-year instrument, not a prepayable instrument. So I don't think we know the answer to that, and it might be a lot, right? So,
if I may jump in, I'd like to talk about the portability of homeowners and home buyers. So one thing that I shared prior to our discussion was, and I feel like the conversation is tough because of affordability, but I think some homeowners have done something about it, and that is they've moved to other metros. So if you look at, while you look at the overall mobility rate, it's been declining, and the number of transactions has been declining. When we look at our internal data, and again, this is very similar to Fannie's data, having worked at both locations, we've looked at inter-metro migration for home buyers, and the share of buyers moving across metros historically about 15%. During COVID, it increased to close to 35%, and it's only down moderately since then. Like, the number has shrunk over the last year and a half, but the share has remained elevated, and it's fascinating because the share that are moving out of metros, and it's almost, and this is net migration, so we're tracking both inflows and outflows. But the net migration is pro-cyclical with home prices. As home prices become more unaffordable, mainly along the coast, more and more people leave, less people go to these markets. And when they leave these unaffordable markets, where are they going to? So you hear a lot about California home buyers moving to Texas, some, Arizona, some, Nevada, some. A lot of them are going to the Central Valley. Riverside's been the #1 inbound market the last 3 years or so. It's affordable. It's an hour and a half away from, I think, from LA. But what's happening, and it's kind of an interesting dynamic, and I sort of call it the migration arbitrage, and I think it's helped support home prices from falling further, is you're seeing a lot of migration into Florida, the Carolinas. It first started along the coast, as you would expect. And here we're looking at only owner occupied. If you look at investor, it's more concentrated, but it started along the coast and it went into the Carolinas, Western Carolina, into Tennessee, Northern Alabama, Northern Georgia, Northeast Texas, Eastern Oklahoma, Northwest Arkansas, Southwest Missouri. It's challenging my spatial ability. Also the 95 corridor. We get lots of questions about how many New Yorkers are leaving New York and they're all heading to Miami. That's actually not true. When we look at the data, there a lot of them are heading. The #1 inbound market has been northern Philadelphia suburbs. And when we look at, and what's really interesting is if you look at some of these sort of popular markets that have had a lot of in-migration because they were sort of at the sweet spot of affordability and amenities. So markets over the last 15 years, Denver, Austin, Nashville, Salt Lake City, and Raleigh, those have all turned negative from a net migration point of view. They became victims of their own success. So instead of moving to Nashville, now people will go to Chattanooga or they'll go to Knoxville. So I think, I think there are a lot of issues that consumers are facing, and this is one way where, some of them are sort of using, it's sort of a release valve, but I'm concerned from a policy perspective is what's happening is that we're flooding these markets and they're becoming unaffordable as well. And so what happens next, right? Because a small drip out of California can overwhelm some of these smaller and medium tertiary towns.
So I think that's a good jumping off point, Ingrid, to think about some of the issues around construction. So if we think about this as really a housing shortage in some fundamental ways that a lot of people would like to live in New York City, we're at a bit more affordable. We're at a time period where financing these kind of buildings is very difficult, and we're seeing a widening gap between permits and starts. So builders are going out and they're getting the permit, they have the permission to build, and then they can't get the financing to work. What do you see as potential policy solutions for dealing with that problem?
Yeah, and I may sort of pivot a little bit. I mean, obviously that, we also just have generally the regulatory barriers to new construction, and particularly to multifamily construction, and if you look at just the supply also, it's sort of, the numbers that where you've really seen a decline is sort of at the low end of the market. And the key federal policy tool that we have to sort of increase the supply of low rent housing is the low income housing tax credit. And those projects, this was the tax credit, the low income housing tax credit was enacted as part of the Tax Reform Act of 1986, and basically it continues to support the construction of something like 100,000 units per year. That's generally what it has over the last decade or so. And basically developers get from the state they get tax credit that they can sell then to investors that they can then use for equity. But increasingly these LIHTC deals are difficult to pencil out. So projects are suffering both from sort of higher credit costs, but and limiting the amount of debt that they can secure. But there's also, you've also seen a decline in tax credit prices down to they're now trading at about 87 cents on the dollar. And this is down from, they were consistently in 2016, they were consistently trading at over $1 per credit. And so that's limiting the amount of equity. This is sort of leading to financing gaps. Now, some lenders are continuing to fund LIHTC, finance LIHTC developments for CRA credit in certain markets, not necessarily the markets that are seeing the growth right now, at least on the home ownership side. Yeah, it'd be interesting to see sort of whether you're seeing that sort of same migration pattern with renters, but I think this sort of it sort of raises this broader question about this sort of key financing tool that we have for affordable housing in the United States is very pro-cyclical. And Ben and I wrote a paper a couple of years ago about whether we could think about just more broadly making U.S. housing policy more counter-cyclical. But the tax credit is sort of a prime example where it's very difficult for developers. First of all, I mean, they rely on investors in order to get their equity. They rely in particular on banks, right? So if banks start losing profitability, demand for the credit is going to fall. The price of the credit may fall further and widening the financing gap. And so I think that thinking about ways to make the credit more countercyclical would be, allowing states to exchange the credit for just direct funding. This is something that the federal government did this through the American Recovery and Reinvestment Act, but it was a temporary allowance, and so you could make that change permanent, allowing sort of states to exchange unused credits for direct financing. You could also think about allowing states, being even more flexible at allowing states to actually, in some markets where gap is really sort of is on the income side and not so much on the supply side, that you could allow them to exchange the credit for demand side subsidies as well. And so those are just a few ideas to try to actually at least help with the LIHTC market.
Thanks. That's great. And I think, definitely an area that needs a significant amount of policy attention. Mike, as we're thinking about another group of lenders who have been very active recently, or I guess maybe more originators, are the home builders in thinking about the inventories that they've been needing to unload. And one of the tools that they've used to do this is temporary buy downs of the interest rate, which in some ways has the flavor of a teaser rate. And so I'm curious, as we're thinking about the sort of landscape of products that are out there, maybe around the builders or more generally, thinking about other innovations around contracts with things like teaser rates. Is it time to bring back teaser rates as a solution to all of our problems?
Yeah, I'd say short answer, no, absolutely not. The industry has just spent the last 15 years removing any form of payment shock from any mortgage, and I don't think there's any interest in putting it back in. In fact, the payment shock that people are experiencing right now is in the form of property insurance and flood insurance, and would rather not have that. So I mentioned the vice president of complaints. One of the biggest complaints is each year you get that escrow analysis and they call and scream, why did my payment go up? It's like, well, it was your property taxes and your homeowner's insurance that went up. The mortgage is the same. So I don't see really any interest in contract redesign there. If you look at the ARM share of the market right now, it's a little less than 8%, and your typical ARM is fixed for the first 5 or 7 years. You can save 75 to 100 basis points by getting that over a 30-year, and tends to be much more widely used by higher income, larger loan balance consumers. On the builder front, actually, what I'm hearing more and more, and it's tough to get great data on this, is to the extent they're being used, they're permanent buy downs. And there are buy down products out there which are, 2-1, so 2 percentage points lower the first year, 1 percentage point lower the second, then you step up. For the payment shock reasons I talked about, nobody's that excited about those, but a permanent buy down they'll take. And what we talked about on the prep call, the other interesting thing about this is you hear a lot about the buy downs. And when I talk to the mortgage affiliates of the big public builders, it's a fantastic marketing draw because people hear about a 5.99 rate and a 7% market. That gets them in the door. Then they make a decision. Do I want the fancy countertop or do I want the 5.99 rate? The builder has a budget to provide whichever one the consumer wants. And it seems like at the end of the day, people want the countertop more in many times, right? So, but the 5.99 rate is a marketing tactic, let me use that phrase, that really attracts people's attention in this market.
So I'm gonna, given that Bob gave the blanket disclosure at the outset, that, our words up here don't reflect the policy, any policy decisions. We should talk monetary policy for a second, and interest rate forecasts. So, both Sam and Mike, your organizations both put out interest rate forecasts, so sort of where you see things headed. Would you sort of share, like, is this problem going to end in the short run with rates falling quickly? Should we expect rates to come down? And maybe that fits into a broader question, which is, why have spreads stayed as persistently high as we've seen?
So yeah, I get the opportunity on a monthly basis to put a forecast out there, and then our members directly put that into their budget, right? So there's decisions about whether to hire or fire people. So it feels pretty consequential, right? So we, for this year, had been among the many folks last fall thinking we'd have a recession, obviously, and with that would see fairly swift cuts from the Fed. In April, we changed our view, just like the FOMC, we are data dependent, right? Both the job market and inflation data just kept coming in. That's not the picture it was painting. So instead of thinking 3 cuts this year, we're thinking 2 starting in September. The other thing we're doing is to sort of, given this experience the last 6 months, while many FOMC officials had projected a low point for this cycle of about 2.5, we don't think we're going to get there. Maybe 3.5. And so the combination of those 2 changes had us raise our forecast for mortgage rates. So we're at 7% today on a 30-year conventional conforming loan. We think we'll be 6.5 at the end of the year, low 6s next year. In terms of volume for the industry, I mentioned 1.6 last year. We think 1.8 this year, a little above 2 trillion next year. So maybe I'll stop there and then we can do the spread discussion.
Yeah, sure. Thank you. So our views are very similar. We were never in the camp. We didn't think, we were not as negative as the consensus. The consensus was extremely negative on the economy. And in fact, there were more, it was in a couple quarters, the consensus amongst economists was more negative about the economic prospects than during COVID, the first few months of COVID, which is shocking. So we were never within that consensus. We've been in the higher for longer camp. Our current view is very similar to Mike's, but we only have 1 cut for next year. I'm concerned about inflation. I'm sorry, this year. I'm sorry. I'm concerned about inflation. Yeah, I'm concerned about inflation. So, the report came out this morning with the headline that inflation's slowing down. Not really. It was 6 basis points. The standard error, I think, is 4, something like that. It's flat. It hasn't moved. It's noisy. I'm worried about the shelter component of inflation. The owner's equivalent, this is a wonky topic. The owner's equivalent rent is a price that nobody pays. I work for a data agency. It's easy to critique all these approaches, and so I'm sensitive to that. But the way this owner's equivalent rent is measured, the BLS asks renters who live in owner-type properties because they're trying to capture the flow of housing services. When I compare that, the OER, owner's equivalent rent, versus the monthly payment for the stock of mortgages that we have, we've got about 13 million mortgages, and we track that over time. They don't match up that well. And so during times of big refi waves, the monthly payment drops. The OER, the owner's equivalent rent, does not. So there's this like wedge that occurs. This happened in 03, happened in 13, happened in 21 as well. Moreover, what's really interesting, what's happening recently, is our monthly payment for the stock again continues to increase at 5 to 6%, while OER is slowing down. And so you're seeing the cumulative impact of the run-up of prices and rates on the monthly payment for the stock of homeowners, but the OER is not necessarily picking that up. So I'm concerned that many households are feeling the pinch more than they are. I think this is why consumer sentiment is so low. And given the deficit to GDP ratio, I just don't see rates declining that much going forward, at least over the next year, year and a half. Who knows after that?
So on the spread, so shorthand, if you look at a 30-year mortgage, 10-year treasury, go back 20 years or so, that averaged about 180 basis points. Over the past, well, for most of 2023, it was at 300. You can find other times in history when it was at 300. September of 2008, when the entire financial system was crumbling. March of 2020, when the entire financial system was crumbling. So 2023 was challenging, but it didn't feel like that. So what on earth was going on? Some of it's just math, right? If you have more rate volatility, you have more prepay risk that feeds directly into wider MBS spreads. That's what was happening. For the discussion, the Fed went from 0 to 525 very, very quickly. That injected a whole lot of rate volatility in the market. You also have sort of this ongoing concern that because of QE, Fed built up this 2.7 trillion MBS portfolio. They allowed it to start running off in 2022. And they have a policy statement, which they, the Federal Reserve has a policy statement which says that they want to get back to an all treasuries portfolio, but they didn't say when. So I think you have investors nervous enough that that will come sometime soon, that they're not that eager to sort of, be grabbing dimes in front of a bulldozer. So what do we know? December, you had Chair Powell really pivot and say that was likely the last hike. You saw that spread immediately come down to between 250 and 260, and it stayed there ever since. So rate volatility has come down. We expect that with the first cut, rate volatility will fall further if they sort of build an expectation for a series of cuts. But we don't think we're getting back to 180 anytime soon because of that sort of ongoing concern about QT. The other factor you had last year was the bank failures, and the FDIC wound up holding about 100 billion in MBS, which they had to sell very quickly. And these were low coupon MBS, and the concern was, oh my gosh, who on earth wants a 2% coupon MBS? And it turns out a lot of people do. That so much of the market is driven by passive index followers at this point that they didn't have one of those. And so they needed to match the index. They needed to get some of those 2 and 2.5 coupons. So I'm less worried about the bank failure channel leaving spreads wider because we seem to have managed that. I'm a little bit worried about the QT longer term, but right now it's all about rate volatility.
That's great. I mean, that's as succinct and accessible a description of spreads as you're going to find. Well, let's open it up to the audience. We've got a few minutes here for your questions. Anybody in the room or online? Yeah, Freddie, you want to use the mic and introduce yourself, please.
Hi, I'm Brittany Lewis from Washington University, St. Louis. This question is probably mainly for Lou, but potentially for the other panelists. Have we seen portable mortgages in like the VA segment of the market increasing? Because I know the VA loans do allow portability.
Okay, thank you for that kind of segue. That was the one thing I didn't have time to talk about. So basically, there's a different contractual option, which is assumability. So all FHA and VA loans, which is about 20% of the market, they actually they are the ones that have been originated, they're assumable, meaning that somebody can come and basically buy your low rate from you. So you can buy the house together with the low mortgage. The issue, and there's been some interesting kind of like case studies out there by like, I think a Wall Street Journal article and just a New York Times article, I think today, where they basically tried that. And the bottleneck is basically that you can only buy the loan that's there. So if house prices have gone up and somebody who's been there has paid down their loan, right? You have to be eligible for FHA-BA, which is like a, like fairly low income, like the riskiest part of the population. You have to be eligible. And then you also have to have a lot of cash in order to cover the loan difference. I think what would unlock that as an option for mobility would be if we think about second liens. Obviously, from a financial stability perspective, we kind of like close the lid on that for a while, but I think that would be like a question to the FHA and VA if they would consider allowing for that or underwriting that. And so that's one thing that basically there's very few people for whom that's attractive. The other thing is that services apparently have been so these case studies, and there is a very interesting article in the Wall Street Journal, like the services have basically not been interested. There's not that much in it for them. And so that kind of comes back to this idea that once you have this disintermediation, renegotiation really requires services incentives to be aligned. And I think that's also where policy should step in. But I think it's a great question.
Yes.
Andrew Davidson. I'm almost more of a comment than a question, but I can turn it into a question. So the title says mortgage market and interest rate cycle, but yet I think we're focused on where interest rates are today. And they're not going to be at this level later. And, when rates were low, we had all this focus on shouldn't we have ratchet mortgages that automatically adjust down? And now we're trying to deal with the fact that rates are high and so people have low rates. Like my view is we should try and focus on mortgage policies that work regardless, recognize that rates are going to change. Some are going to be premiums, some will be discount. It's very hard to change the mortgage contract because of the way we finance so much of it through mortgage securitization. And even the reason we're at the place we are now, to me, is largely due to Fed action that created rates that were too low relative to where the rest of the economy was for some time, and created this boom and bust. And so anyway, so I guess there could be a comment, but like, how do we have caution about recommendations for policies that are focused on problems now rather than the problems that those solutions cause later?
Anyone want to tackle that?
The only thing I'd say is that I think that does, sort of suggest that we should be thinking more sort of about ex ante. What are those? What's the mortgage policy that we want going forward to sort of that would help stabilize the market and all different kinds of forms of volatility?
And I think also it's who's going to bear the risk, right? So in a fully adjustable rate mortgage is an option. Those contracts are out there, and we're seeing the effects of those in other countries where everyone is now forced to mark their properties to market. So this is the fundamental asymmetry of a fixed rate mortgage system, right? It's not an easy solution, and it's not an easy thing to move away from once you've kind of decided that that's going to be the equilibrium contract. Other questions? Yes.
Hi, thanks very much. Great panel. This is Ralph Giroux of SGI Wealth Management. Just to give you some context, I started trading mortgage-backed securities in 1983 on Wall Street out of a paperback book. So I'll show my age. I used to use Andrew's research, and the great financial crisis made me an instructor in finance at Rutgers. And so two opinions. First, COVID's maybe changed the starter home market forever because of hybrid work. For example, I read anecdotes about 4-bedroom homes as a minimum for builders, right? Because I know a couple students got married, bought a 4-bedroom, 1-bathroom. They call that a starter home because they each wanted an office. One person works for BlackRock, one person works for Deloitte, right? And then the other comment I might ask you about is, do you do research on square footage to compare renting versus buying?
We have looked at that, and so they are buying smaller homes. That's part of their decision. Builders have been building smaller homes in response and also smaller lots. This is actually not that well known, but they've been doing this for the last decade or so. The shrinkage in the lot has been much, much more than the shrinkage in the square footage of the home. What was your first comment?
Just about, well, not only I'm thinking about your research in terms of renting versus buying. So like, what the cost is of a square foot for a renter versus the square foot for a buyer. And do you look at that research when you think about affordability, right? Because we have tight supply in the multifamily market, that might ease up a little bit.
Yep.
And we have tight supply in the residential market.
Yes, if we do look at it, I actually just remembered one of my responses to you, which is that and I haven't seen any analysis on this, and we haven't written on this, but if you look at CoreLogic, I just know CoreLogic because I used to work there. They have a single family detached home price index and a single family attached price index.
Yeah.
The appreciation gap between the detached and the attached series really blew out during COVID. And I don't know if that's anecdotally, it sort of makes sense, but that provides the quantitative evidence. I was surprised at the differential appreciation rates that you saw. And this is a repeat sales, and right, so it's tracking the same homes, just different structure types. And I just think that's sort of interesting. And I haven't seen, maybe someone's published on this, but I haven't seen analysis, but it's interesting.
No, thank you for that. I think that would be great research to follow in terms of detached versus attached and looking at that. Thank you.
Well, thanks. We could talk about this topic for much, much longer, but we're going to stop right there. So please join me in thanking our panelists.
So we will return at 4 o'clock from the break, and we'll try for